Hello ladies and gentlemen, welcome to the Strategy of the Week for Friday, October the 4th of 2013. This is Dan Misch. I'm the Director of Retirement Services, and I'll be taking us through tonight's presentation, which we have titled Senate Straddle. And we all know there's a lot going on in Washington right now with the debate over the Affordable Care Act and the debt ceiling and the shutdown of the government. And tonight we are going to focus on some of the stocks that would be in the healthcare sector that can be affected by the decisions that come out of Washington. And the way we're going to take advantage of that decision is by using an options trade called a long straddle. And when you have a long straddle, what you do is you buy an at-the-money call and you buy an at-the-money put. Now I'll stop right there for 1 second. We are buying these options, so we are taking money out of pocket to get into the trade. Both the call and the put will be at the money, meaning we'll be buying the strike price as close to the actual underlying stock price as possible. And we will buy that call and put on the same stock with the same expiration date. And what we're hoping for here is that the stock will just move up or down in a significant fashion, one way or the other, and with this long straddle, we'll be able to take advantage of that. This graphic here shows us the profit and loss diagram for a long straddle. And so we have this V-shaped pattern, and at the beginning of the trade, we start right down at the bottom of the V at the point. And that represents the maximum loss we can have on this trade. The total dollars we spend to buy that call and put is the most we could lose on the trade. The bottom axis is the price axis of the underlying stock. And as the stock would rise up to what is a break-even point, we would have unlimited profit potential. As high as that stock price will go, that long call will allow us to participate fully. If the stock price is moving down, we will once again have a downside break even, and then we have unlimited profit on the stock price falling until it hits zero, of course. It can't go any lower than that. And so whether you believe the ACA will be funded and implemented in full, whether it will be delayed and implemented fully later, or whether they try to blow the whole thing up, it certainly is going to have an effect on some stocks, and whether they go up or down, once again, this type of trade will allow us to participate and make some profits. So I've moved us into the VectorVest 7 program, and we're looking at a watch list that I created. You can see I have it in my watch list group, and I've titled it Senate Straddle. And all I did was go out to your favorite internet search engine and type in things like Obamacare stocks, or ACA stocks, or stocks affected by the current Senate decision, anything in that vein, and you're going to get all the pundits telling you which stocks may or may not actually have some benefit to you. You could also look through the various newsletters that you receive. And so I've taken just 6 of them and put them in this watch list. From the managed care area, we have Humana and United Health Group. From pharmaceuticals, we have Pfizer and Merck. And hospital management companies HCA and Community Health. Humana is at the top of the list because it has the highest VST score, and this watch list is sorted by VST, as is our default in the program. The first 4 have that VST above 1, and Community Health and Merck are just slightly below with each a 0.95. And so again, what we're hoping for with any of these stocks is that they're going to make a significant move up or down. And so to get an idea as to whether that's a real possibility, I'm going to highlight all 6 of these stocks, and we'll take a look at the stock graph. The first one in the list is Humana. You can see it began 1 year ago at around $75. It did fall down to a low of $63.93 before moving both up and down with a nice rise up to where it's currently trading at $96.68. United Healthcare tells a similar story. It fell down to its low in November of last year at $51 and has had a nice rise overall over the past year and is currently trading at $73. Pfizer has been on a little bit more of a wild ride. It hit a low 1 year ago of $23 before rising up to a high of over $31 and trading bumpy and sideways a little bit, still right now at just below $29. HCA hit its low in November of last year at $27, did recently trade at a high of $47 and is still up at $46 and certainly has been in an upswing as of the past week. Community Health was on a nice ride for a while before it really started to hit some bumps in the road, trading as low as $26 and as high as $51 in the past year, currently just below $44. And Merck is certainly the one showing the most volatility with a lot of ups and downs over the past year, with its low coming just in January and its high coming in June of this year. And with any of these stocks, really what we're hoping for is the past to repeat itself, and in some way we're going to get some continuance of the up and down motion. Now, in order to analyze this type of trade, we are going to use an add-on tool that's called the Options Analyzer. If you do not currently own the Options Analyzer, there will be a link in tonight's VectorVest Views where you can take out a trial, or you are always free to call our offices and talk to one of our consultants about setting you up with a trial or purchasing the product. One extra note I'd like to make is that we do give away the Options Analyzer for every attendee of our one-day options course, of which we have several opportunities for you to see us in the final quarter of 2013, and we'll look at those dates at the end of this presentation. So we'll begin here with United Healthcare. It's currently trading at just over $73 per share. If I click on the Tools button in the upper right-hand corner, those of you that do have the Options Analyzer will have this option to toggle it on, and it does open up a separate program. I'm going to begin in the upper left here by typing in the symbol for United Healthcare, and then just below there in the trade settings, I am going to edit this, and because we're in the month of October and the expiration for October is only 2 weeks away, for tonight's examples, I am going to use a November expiration, and the third Friday in November of this year is November the 16th. Over to the right, we can see the various bullish, neutral, and bearish trades we have. A long straddle does fall under the neutral category, and so when we click on that, we'll get that same picture of the profit and loss diagram, and we can go ahead and choose to analyze the position. When you first get into the Options Analyzer, it will default to the analysis graph, which is set out at the expiration date on November the 16th, 2013. You can see that familiar V-shaped pattern that we looked at from the previous profit and loss. The bottom axis is the price of the stock. The left axis is the profit and loss from your straddle trade. Also plotted here on this graph, we have two boxes, and those are showing us the break-even points. So to the downside, we want the stock to go lower than $67.94. And to the upside, we want it to go higher than $77.06. And the further the stock goes below or above those break-even prices, again, you can see the corresponding level of profit on the left side axis. Down at the bottom, we do have both legs of this trade shown for you. So we have the long calls. It's a $72.50 stock. That's as of yesterday's closing price. So we're looking at a strike price of $72.50. For demonstration purposes tonight, we will be showing 10 contracts of both the calls and the puts. And with each contract meaning 100 shares, we are controlling 1,000 shares. So we bought the calls for $2.30. We bought the puts for $2.26 for a total debit to our account of $4.56. Multiplied times the 1,000 contracts means we have a debit to our account of $4,560. So we can get through some of these demonstrations. I'm just going to show you some examples of what if and how you can do that using the Options Analyzer. We know the stock closed yesterday at $72.52. Well, what if the stock were to have a 10% rise above that price? That would take it to $79.77. And if the stock closed at that price on the third Friday in November, we would have a profit of $2,710, or roughly 60% of our original $4,500 investment, that we could close out this trade. If things don't go well for United Healthcare and maybe the stock price drops by 10% from its current value, we'd be down at $65.26. Then our puts would be the ones that are making us money, and it would give us a profit of, again, roughly $2,700, or 60% of the original investment amount. Now, besides plugging in numbers here and looking at where that your profit and loss is on the graph, we can view the Reports tab and look at an analysis report. It will begin at roughly the starting price of the stock, which again right now is fairly close to $73. This stock trades in $2.50 increments, so we are going to move up $2.50 from $73, and we are also going to move down $2.50 from $73 5 times each way. And this table shows us those 5 to the downside and 5 to the upside. And as the stock price rises or falls, you can see what happens to the value of the call and the put. Your debit will remain the same no matter what, and you can view in a tabular format here what your profit and loss is on that trade. If we want to analyze another stock, we can stay right here in the Options Analyzer. I'll click the red X to remove all those trades, and I will go ahead and put in MRK, which is Merck. That did have a lot of volatility in that graph we looked at over the past 1 year. Making sure we're set for November, we'll once again choose a long straddle and analyze that position. Now, this stock closed at $48.36 yesterday, so we are trading both the 48 calls and 48 puts. Again, the November expiration and 10 contracts. The calls cost $1.58, the puts cost $1.20, so $2.78 times 1,000. Our total investment here is $2,780. We want the stock to move above 50.78 or below 45.22 by the third Friday in November. So let's use that same metric. 48.36 plus 10% would give us a stock of $53.19. In that instance, we'd be able to close out with a profit from our calls of $2,400, or roughly 85% of the total investment. And if Merck happens to go into one of those down periods, as it is prone to do according to its graph, down 10% would be $43.52. And in that case, we'd have a $1,700 profit from the puts, and that is roughly 60% of our total investment. The Analysis tab, once again set in 5 increments up and down, will give you that tabular format. Now, there are a lot of stocks that are going to be affected here, and we've just chosen a few for demonstration purposes. If you don't want to trade an individual stock based in one industry of healthcare, you could trade some of the ETFs that are out there, and one of the most widely traded, particularly for healthcare, is symbol XLV. So I'm going to go ahead and put that into our watch list. All right, here you can see the S&P Healthcare XLV ETF, currently trading at just over $51 per share. By right-clicking on the stock and taking a look at the full stock analysis, we can see that this fund seeks to provide investment results that correspond to the price and yield performance of the healthcare select sector of the S&P 500 index. The index includes companies whose primary business may include healthcare equipment and supplies, healthcare services, biotechnology, and pharmaceuticals. And we can see by the X indicated next to the A for the American exchange it trades on that it does have options available on it. So we'll once again move into the Options Analyzer. We are looking at symbol XLV, a November expiration, and a long straddle. Now, the first thing I notice here is that those break-even points have certainly been moved closer to the bottom of that V. We have a roughly $51 stock, so we are trading a $51 strike on both the calls and the puts for November. 10 contracts. The calls costing us 83 cents. The puts costing us $1.27 for a total debit to our account of $2,100. Those break-evens being closer to the strike price means we don't need a lot of movement to the upside or downside. We need to go to 53.10 or 48.90. Now, should this ETF have such a movement that it goes up by 10% from its current price, that would be at $55.72, which would allow us to take a $2,620 profit, or 125% of our original investment. Should things get fairly dire for the healthcare industry and XLV were to plummet down 10%, then you'd be able to close this trade with a $3,310 profit, which is 160% of your original investment. So these straddle trades can allow you to make a lot of money when you have particular stocks or industries or sectors that are going to be affected. And with the healthcare debate being as strong as it is at the forefront in our country right now, we thought this was prescient to show you these type of trades tonight. Now, we love teaching our subscribers how to do these types of options trades, and we're going to give you several opportunities to learn even more in live classes with our instructors. Here we are on the VectorVest website, and you can see upcoming throughout October and November, we do have our one-day options course, which will be held in St. Louis, here in Cornelius, North Carolina, Pittsburgh, Pennsylvania, Tysons Corner, Virginia, Cleveland, Ohio, Las Vegas, Nevada, and those are just in the United States. We do also have our options course, which will be shown in Vancouver, Mississauga, and Montreal, Canada. So if you're interested in those classes, please take a look at our website and register. Again, we will give you the options analyzer for free for coming to that class. Thank you for joining us tonight. If you have any questions, please call the number on your screen.